welcome to this very special show, Markets and the Mandate. Well, we are going through that phase in the market where every narrative, every conversation, and all the talking points are really centered around election cycle. Historically, that really has been the case. I would say not 8 out of 10, but 10 out of 10 conversations are really centered around what would be the really high point of this election cycle and what really would be the impact of this time's election cycle on the market. But historically, if one really looks at the data point, and they always say that history may not repeat itself, but it certainly rhymes, how have markets acted, reacted, and positioned themselves in the run-up to the election cycle? So what we have is a lot of discussion and a lot of focus on what you should do, how you should do, and what should be your positioning in the portfolio?
Oh yeah, absolutely. And considering the election cycles are long, so we're not going to go into historical data. That, of course, is coming up for you on your screens. How the markets have panned out in 20 days prior to the elections, on election day, and of course 20 days after as well. That is history. What one needs to really focus in on what's happening with the markets right now. In the last 20 days alone, the VIX definitely has spiked up. While we may be just a minuscule away from the all-time highs once again across the board for all indexes, and from the Monday lows itself, the markets have made a meaningful recovery coming in. I think we're away just about 2.5% from those all-time peaks, or actually 0.5% or so. 2.5% is the kind of recovery that we've made from the Monday's lows. But yes, the heightened volatility, that continues to be a concern. The fact that VIX continues to hold above that 20 mark, that is a little bit alarming. So one needs to see as to what is it that you should be doing in the run-up to the elections. What should your portfolio look like? Should your portfolio be election-proof? Should you actually bet on the election trade? Who better than all of our in-house experts joining in today to explain and highlight exactly that? We've got on the charts Nooresh Merani, Kunal Bothra joining in. We also have Sandip Sabharwal right here in the studios, and Sanjiv Bhasin, as always, is well with us. Kunal, firstly, to set the context, because like we've been talking about, right, the FPI short positioning is at an all-time peak, typically. Last time we saw that was when? When COVID lows, right?
The next one was 23.
Yeah, 23. So from there, and the kind of DII buying that we've seen, what is the screen and the ticker telling you?
So no, it's a very interesting context because the FPI shorting, whenever that has happened and whenever that's occurred at a multi-year, multi-month high or an all-time high, in that context, the indices have always managed to make a major bottom for themselves. Now, what matters is that the context which you have to look out for is that the bottom doesn't happen immediately. It's a process of the next 1 or 2 weeks that the market finds a bottom. So we've already gone through a VIX rise of 100% jump. So from 9.8, we went up to 2021 for the India VIX. We are now just about mitigating at the 28 or 2021 odd level for the India VIX. But the context of the FPI short, I think that indicates historically, and I think there are some 5-6 instances over the last 12 years. Whenever that has happened, the index has gone through not just a recovery or a rally, but they've gone through a V-shaped rally. And most of those bottoms which have been formed have never been tested ever.
Sandeep, is the mood looking like we're headed in post the election event for a V-shaped move and a parabolic one at that? Considering we've not fallen too much, we're pretty much around the all-time peak.
Parabolic move or not, it's tough to predict, but I think what I can see as sentiment is people are too negative. I think for some reason people are very negative. They are negative on election results, they are negative on things. I am not sure why, because statistics don't show that. So I think that by itself is giving support to the market and recovery wherever the correction happens. And I would think that the election result should be in line, is my guess. And if that happens, I think markets should remain stable, because there are still fears around what could come in the budget, etc. The government has tried to negate some of those fears, but actually what comes out or not, so there are fears about capital gains tax, direct tax code, and all those things. So I think that event will need to pass. My guess is that should be somewhere in the first week of July. And if we don't get any negative surprises there, then I think the market will be set for a decent move.
Okay, so I'll just set the data point here, and frankly, there is no clear pattern at play. We're looking at first data point, which is that in the run-up to the election, let's say 20 trading sessions, about a month, in 2004, markets fell by 8%. 2009, they were up by 8%. 2014, up by 5%. 2019, markets actually were flat in the run-up to the election. That is important. But the interesting bit for us this time, and they always say, what is different? Naya kya hai? This is the differentiating part. The FI holding, what Aisha and Kunal just discussed, the FI positioning in the F&O market is at a 10-year high, which means the number of short positions by foreign institutional investors are at a 10-year high. But similarly, the number of the positioning of retail in the F&O market, and bear in mind that the market participation by the retail category is also expanded, is at a all-time high. So it's like reverse. FIs are hedging by going short, retail is long, assuming that they expect a post-election rally. Is that a fair assessment, Nooresh?
So there is one way to look at the data. The data is in number of contracts, and the contract value for Nifty has gone down from 50 to 25. But even after cutting it by 50%, it is one of the larger short positions we've been in. And the fact is, if you look at it, FIs have been selling. They've been selling in cash. They've been selling in futures. But the fact is, if you look at DII money over the last few years, every year DII inflow has been higher than FIIs. And we are at the cusp of the time where DII holding will be greater than FII holding. So what really matters going forward is, post-elections, we are not even considering the fact that FIIs can become buyers. If that happens, the flow changes could be phenomenal in terms of market participation. We've not seen that for, say, we saw it in 2020 to 2021 and see the smoothness of that rally. We've seen it in 2017. So when DIIs plus FIIs become buyers, we are not in sync to understand what sort of moves can happen.
And I'll establish that data again with looking at the FI positioning in the cash market. In the month of May, which is about 15 days, foreign institutional investors have been net sellers to the tune of 37,000 crore. The same positioning in 2019 was negative, but 7,000 crore. And 2014, guys, it's not once upon a time, only 10 years, was 11,000 crore. So the FI positioning in the run-up to the election has been strikingly different. Bhasin Saab, break the data for our viewers. Are we in for a very sharp rally which could be fueled by foreign institutional investors who right now have a short exposure and they've been selling in the cash market, and if markets like the election verdict, we could see a monster bout of short covering, which is that foreign institutional investors will be forced to cover their positions?
Yeah, good afternoon. Well, I would expect something like that if the results come as per what the market is looking and you get stability. Because Nikunj, what has changed is that global cues have become very positive. The Dow is 40,000, China market is back, Indian macro and micro are looking good, rainfall is good. So I think in the bonhomie, the people who are missing out or who have, who are opting for China or whatever, there will be a huge bout of covering. I would take that as a selling opportunity. So I think domestics will sell heavily once the FIs come and you hit new highs. And I think that is very much on the card. I would say 80% probability.
Sandeep, but what is making the FI fraternity that nervous? It can't be only elections, right? I mean, there is a lot of debate about whether money is moving to China and Hong Kong kind of markets or back to the US. What's really happening?
Yeah, so it's a combination of everything. It's nothing to do with India except the valuations. So FIs are not selling because of election uncertainty, X, Y, Z. It's just pure valuations. They see Indian markets have run up so much. They see profit opportunities. And Chinese markets were depressed so much. If you see the rally in the Chinese market, whoever shifted out of India into China has actually made big money. Then money shifted to Europe. Money shifted to Japan. So many countries have seen flows, and finally the pool of money is the same. Yeah. So it has to. So we can't always be getting money. Yeah. So that's not necessarily negative. I think what it does is that it provides some stability to the Indian market because domestic flows are so strong. So Nifty, I think if we see today, is up 3% this year, right? YTD is up just 3%. So which is okay. So FIs have been selling, domestic investors have been buying, markets have been stable. So markets need that phase of stability and consolidation also, which is happening. Foreign investors will return to India. When will they return? I think once it gets established that US inflation is clearly on the way down, US dollar starts to weaken, I think India, including all emerging markets, will get substantial foreign investor flows. And it's a matter of time now. So whether it happens next month, 2 months later, 3 months later, we don't know.
Okay, so I'll now open 3 questions, and I would urge everyone on the panel to react to these 3 questions. I'll start with you, Nooresh, and these 3 questions are simple. Market scenario in these, market reaction in these 3 scenarios. Clear majority. What happens to market immediately? What do you see the market reaction?
Up.
No, up to hoga hi, but how much?
Closer to 23,000 or 23,200.
23?
23,000 to 23,500.
Okay, so not like a sizable rally.
Not really. You're not looking at a 10% circuit type moves which have happened in 2009 or so.
Weak majority?
Still we'll be up. We may not go to 23,500, we'll be at 22,800.
Loss? Change of government?
Change of government, I think it is not in the picture as of now. If that happens, we've seen 20 years back, 2004. But the fact remains, we are only looking at India. 2004, 17th May, 8 out of 10 markets across the world were down because of our Indian elections. No, the trend was down. So as of now, the most important part is the trend across the world is up.
Such a great point. Kunal, 3 scenarios, clear majority, weak majority, change of government.
So the markets are very pessimistic so far, and I think in that context, if there is a clear majority, I would expect maybe a 8 to 10% rally from current levels.
The index alone, that day, June 4th. Wow.
Okay. Haji, you want to beat him? 8 to 10% is the
He
hurdle
can't
now.
be beaten. But I think 8 to 10% looks improbable because that continuity is something which is expected in a way.
So clear majority, weak majority, change of government.
What is weak majority? Majority is majority. So in my view, 400 seats is
Like a
negative.
sub 300 types.
I don't like a 400 majority. So if 400 majority, I wouldn't be long-term positive for India. But 280 to 320 kind of number, I am very comfortable with. And I think that's positive for India. And markets will rally because of that. How much? Maybe because markets have not fallen so much, maybe 1-2% immediately. But then the trend the trend will not get broken. If the government changes, I think on a one-day dip could be as much as 15% also. But I think the bottoming will happen because of fundamentals, etc. sometime soon after.
Sanjiv, is the market pricing that in at all, a sub 300 figure for the current government?
No, I think market is clear that there will be 320 to 340, and it's sanguine. And like you all asking, it depends on where we are on 3rd of June. If we are already at 23,000, then it leaves very little on the upside, because there will be one camp which is going to be on the starts to buy or re-enters, and the other will take the opportunity to sell. On the other hand, if there is no majority, then there can be a slam dunk, which will be expected because the pace of reform. But I think what has happened, Aisha, is Indian markets have become mature, and the retail investor is a sign of maturity. So any exuberance or despair is going to be short-lived. That is what we are saying. We are going to be on global macros, earnings, and global cues. But Indian investor is mature. The markets have become much more sanguine. I don't see runaway rallies or runaway falls.
Now let's put out what could be called as election-proof portfolio. So we've really urged our experts here to give some of the top ideas, and which could be called as evergreen ideas, where they're happy to own them irrespective of the election volatility. So I'll start with you, Bhasin Saab. HDFC Bank, Coforge, and Vodafone. HDFC Bank, some would say, is slightly easy to understand, but your choice of Coforge and Vodafone, why are they part of your election-proof portfolio?
So clearly, HDFC Bank, like you said, will stand out, since I think if there is anything to do with negativity, it will still be one of the best plays. Coforge, I would say, large part of the damage is in. They are one of the fastest growing mid-cap ITs, which is now looking to improve their implant as far as AI and this acquisition. And I think the not having any promoter is a very big boon. I would say that somewhere down the line there will be a big buyout, and that could actually be very, very positive. The stock has underperformed, and I would expect it to outperform whatever the scenario. Idea Voda is a clear place that the AB group has got re-rated, and I think that you cannot but make money, because at 40% of EBITDA and 142 ARPU, there is only place to go up. Now, despite any government or change or not, data and telecom is going to be in a very sweet spot, and I think they have all the three, incomings now. Good leadership which is going to see that they are in the fray, and a very good opportunity for investors to make money, with I think the balance sheet getting much more stronger over the next maybe 1-2 years.
Let's have your list. Firstly, what's on the avoid list completely in the election event, and what are your large cap, mid cap, and small cap ideas?
So the avoid list is to look at avoid chemicals, which is overowned across the board. So that's a sector which has done really well. And then large capital good companies, because they've gone overboard. A lot of these stocks are at crazy valuations and crazy strength. If you look at overbought zones rather. So the risk reward is off. So that is a clear cut avoid.
Avoid ABB Siemens?
Yeah, all of them.
And L&T also?
L&T is not in the overbought zone. So ABB, Siemens, you can look at other smaller companies also in the same. Schneider Electric has gone way up. So across the whole capital goods space, this is a time to actually book profits. The ideas which I like, one is continue to like metal. So Hindalco is the new name, which has broken out of a 2-year cup and handle. Aluminium prices have bottomed out, started showing a rally. Very similarly, we were placed on, say, Vedanta when we were discussing. Copper was at $4. Now, aluminium could be the next trade, so Hindalco is one. Second mid-cap idea is GE Shipping. That's a stock which has been in a strong uptrend. We are seeing a lot of volumes, bulk deals happen over the last few weeks. It's been sideways for the last 3-4 months. Decent enough numbers which have come up for the quarter. So the stock looks interesting, is more a neutral, market neutral stock, and not very well tracked or interest in. So that is second. Third is Delivery, which is a stock from the new age companies, which has gone through a 50% correction. Then we get through that 12 to 18 months of consolidation. Very similar to what happened at PB Fintech at 400 rupees or 50-70 when we were looking at Zomato. A very similar structure. The stock is absolutely listless for the last 3 months, almost at a 20-pointer range. So at 400, 450, this looks interesting as a turnaround story in the new age companies.
And you would buy these stocks irrespective of the election?
Yeah, so all these three names are irrespective of the elections.
Kunal, let me turn to you.
So I'll go with large cap names like L&T. I think that stock has been an underperformer in the last 2-3 months, and there could be a very strong catch up which could be at play for L&T. The risk reward is quite attractive, and the stock is still continuing to be exhibiting patterns of higher tops and higher bottoms. So I think that context, the trend is still very much intact for L&T. So 3800 could be a target for L&T, and stop loss at 3200. BHEL is the other stock, and I think that stock has gone through almost like a V-shaped recovery from 65, 66. I think just 2-3 years back, the stock is now almost on the verge of breaking 300 mark. So that's another stock which is looking attractive. 330 could be a target, and stop loss is 270. And the third name which is very interesting, and that's sprung up over the last 1-2 months, is Amara Battery and Mobility. That's a chart which has come back into a multi-year breakout above 1050, 60 odd levels. So that looks attractive for a potential target of 1200 and stop loss at 1080.
And what's your avoid list, you said?
So it's sugar, chemicals, and the underperforming names like paints, etc.
Okay. Sandeep, avoid. Let's discuss that first.
So avoid, I'll take cue from both of them and say
Chemicals.
paints and chemicals you should avoid.
Why?
Well, paints has all of us know with Grasim coming in, what's the kind of price pressure that's there in the market, and the companies, despite that competition, saw profit pressure this quarter. So I think this year and maybe next year will be tough. And once that plays out, then eventually I think some of these quality names like Asian Paints, maybe 12 to 18 months down the line will present buying opportunities.
They say you never say never. Now you don't know what the election verdict could be. If markets don't like the election verdict, do you think the fall in small and mid-cap stocks could actually be very excruciating? So as a strategy, just don't keep too many small and mid-cap stocks in the run-up to the election event?
Yeah, so I think the strategy will depend on what you bought and when you bought. So if you bought something very early, you are sitting on huge gains, so you don't want to just exit that thinking of a negative event. But if you are looking to allocate fresh money, then I think it makes sense to be a bit cautious, because you might be expecting something as a 95% event, but you never know what comes out. So to that extent, that risk is there. And in any case, the small and mid caps, the fancied names also have run up so much that some of the names I would also own. Like, I wouldn't be buying in them today at this price, because I think they have run up too much too fast.
Your buy list includes, and Nooresh and Kunal would say copycat if I say L&T.
L&T, yeah. So L&T, yeah, because I think L&T is underperformed because of result delivery, and people saw that they have guided a bit less in
They
terms
also
of
have an IT business, Sandeep, and that IT business is going through its natural part of contraction. So while we look at L&T as infrastructure, that IT sum of parts should also come down. So why buy an L&T?
because the contribution of these IT companies to the sum of parts is 200-300 rupees. So 550 rupees up or down it happens depending on what their outlook is. So longer term, I think it has good visibility both domestically and overseas.
You also like Praj. You've been liking Praj for a while.
Yeah, so once that ethanol thing happened, so at that time I said we need to avoid this sector for now and buy them near the time when the elections are getting over. So I think the stocks consolidated a lot. It's got a very strong business model. I think once the new government comes up and assuming continuity, we'll again see a huge focus on ethanol. They are very strong on the CBG side also. So I think we've seen many of the capital goods stocks do very well in this period, last 7-8 months. If I'm not wrong, Siemens, ABB and all would have run up 50-60% also.
Yeah, easily. Yeah.
I saw ABB yesterday 70%, Siemens 70%.
Yeah, so the stocks consolidated. I think both valuation and fundamental wise it presents a contrarian opportunity.
But Sandeep, if there is a continuity of the government, which in all probability it would be, would you say that the bigger trigger would be the budget then for the markets after the one-day event which June 4th will turn out to be? Because that will be kind of the litmus test, whether you see defense, railway allocation, continuity of those schemes, which have already been very strong and have worked out very well for the markets.
Yeah, so railways defense is outside the budget more or less, because the order flows, whatever development they are doing are huge, and that will I think continue in any case. The budget now is only important from the point of view of taxation. So whether they tinker with taxation or they continue, because GST and direct tax collection have been so strong, there is no need actually for the government to increase taxes, because consumption is one side which has been weak because of high taxes. So that's the only thing. Hopefully they don't increase taxes more.
Okay. Let me now ask all our panelists, what should really be the tactical approach, which is that should you buy puts, should you buy calls, should you sit on cash if you don't trade or if you don't have intentions to perhaps lean towards the F&O market. So Sandeep, if your view is that a stable government is in the price and this event may just turn out to be a no event if there is return of the current government, which means markets may nothing big will happen. So does it make sense to sit on 15-20% cash? In the eventuality if markets don't like it, at least you have some gunpowder ready.
Yeah, you should have 12 to 15% cash. So if for some reason you are fully invested and you don't want to sell, I think that's also fine, because even a drawdown will not be very significant. But as a strategy, I like to have some cash on the sideline, because when some new idea comes up, it's very tough sometimes to sell what you have to buy something new. But if you have cash, you can buy that.
Kunal, would you buy puts? Would you raise cash? What would you tactically do in your portfolio?
Buying puts may not be a better strategy this time around, because
Not be a better strategy. Okay.
Because we are talking of IVs at 2021. So in historical context, yes, the IV has gone up to 30s and 40s and 37s also. But I think in the context where we are right now, the global setup, etc., I think it doesn't make sense to have put options or call options, because they are extremely overpriced as it is. Both of them are overpriced, because when you see a 100% jump in the IV, the premiums which were, for example, 100 rupees, 100 points, it's almost like 200 to 50 right now. So the edge which you have.
Markets are saying that if the government comes back, it will be a no event. That's the consensus view, that the current government is coming back and this will be a no event. Then the upside is limited. Then why buying call is, why call rates have gone higher?
So I'll give you an example. For example, if the Nifty is at 22,500, say if you're buying 1,000 point out of the money strike, which is 23,500, I'm not sure the current price, but assuming that will be on an IV of 10 or 12, the IVs would have been at say 100, 120 points. Right now, the premium for the option is 200 to 50. So then you're expecting the index to cross 23,500, move by another 250 points, you break even, you come back into break even in terms of the premium for the options, and then you'll start making money. So that's the point.
Nooresh, Monday, June 3rd, what would be your strategy?
So the fact is, you just stay the course, continue to the same asset allocation. Elections, so say I started in the markets 20 years back and lost major money shorting the markets after the election results, and we got the best markets, right? So assumptions is we focus a lot on our events. Same way 2017 demonetization happened, we got a rally across the world. It was not because of it was a global rally. So for now, if the global trend is positive and if you're a trend follower, you do nothing, you just follow the trend. So if we were in a 10% downtick for the global markets, I would have said take the puts. And 2 weeks back, they were at 10 IV. You could have done that. Now, even at 20 IV, the market is not pricing a 10% move. So in that sense, do nothing. Continue with the same.
You know, it's just been such an engaging discussion. We've really covered a range of topics from what markets are expecting to what should be a portfolio strategy and some stock ideas as well. So I think we are likely to discuss more of the same, at least in the run-up to the election. So that's the moot point. And this, in a sense, really is a summary of what should be the very basic portfolio approach in the run-up to the election.